On All About Stocks this week, the markets are in correction mode. We'll tell you what your investment strategy should be. Our guest Nitin Jain gives us his outlook on the markets for 2014 with a list of stocks and sectors to focus on. Nitin also picks out 2 stock ideas that will make us rich in the long term. Welcome to All About Stocks. You're watching ET Now. I'm Faye D'Souza. This is a show meant specifically for long-term retail investors. So I'm so glad you tuned in. Well, 2013 is winding down and now we look ahead to the new year. And we'll find out if it's time for us to rework our investment strategies and our portfolios. Now, there's a whole list of important events to watch out for. There's an RBI policy meet where we're expecting another rate hike. There's the tapering from the Fed and the general elections in the new year. Today we'll find out what your investment strategy should be for the new year and how you can prop up your portfolio to make the best returns possible in the long term. Remember, our email ID is at the bottom of this screen and you can send in any question you have about your money or about your stocks. Let me bring in my colleague Ajay, who'll give us an update on how the markets did this week. Ajay, we had a big Monday, but the rest of the week was sort of on its way down. Take us through it.
Well, Faith, this week was quite interesting for the markets. Not only did we make all-time highs on the Indian markets, but the swiftness by which we have corrected after making that new high is a bit surprising. So it was a damaging week. On a net basis, we've lost around 1.5% on the key indices. In fact, the outperformance which was being seen by the mid-cap and the broader markets also got subdued this week, and they fell in line around 1.5%, losing this particular week. Traders say that they've been booking profits out of the cyclicals, the entire auto, banking, capital goods stock which had rallied quite sharply in the last couple of weeks. They feel that the entire hope trade, the BJP leading in the state polls, all of that good news and excitement is in the price right now, and hence it is prudent to book profits, and that pretty much got played out in today's on this particular week. Also, one large section of the market, which is the domestic funds, they have been consistent sellers this week as well. The extent was clearly reflected that out of the 5 trading days this week, 4 trading days we actually lost on the key indices, and more pronounced was the selling from the DII side. Going forward, important week for the macros, because not only US Fed meet, but our own RBI governor will hold its monetary policy meet, where expectations are that there would be a hike of repo around 25 basis points, looking at how the macro data, especially inflation, has been much higher than what the traders have been expecting. So they are hiding positions or taking positions, taking some comfort into defensive like IT, pharma, to a larger extent consumer stocks as well, and they say that staying away from the high beta like cyclical sectors is a prudent strategy to do going forward. They also say that global cues will play a very large role, because not only Indian markets corrected this week, emerging markets as a pack have been trading weak and have been in a corrective phase going into the all important US Fed meet. So all of that will be playing on the traders' minds next week as well. Also, mind you, it's a December month has started, and December historically has been very weak as far as FI activity is concerned. Most of the American and European funds see their accounting and their books come to an end. So activity on the fund action is low, more to do with admin work. So that is also one thing one need to discount while approaching the markets next week.
All right, Ajay, thank you for that update. Joining us today in the studio, Nitin Jain, the head of retail capital markets at Edelweiss Financial Services. Nitin, thank you so much for joining us. We could talk about how the week played out, but as retail investors, that's a really short-term view. Let's talk about the new year, all of the things that will change. I want to understand from you, every time we sit down with someone, they tell us that the general elections is the next big trigger. How much should that matter to us as retail investors, and how much will change with the elections?
No, it depends a lot. It depends a lot in terms of how the elections pan out. I think the markets are really looking forward very positively to the general elections. But having said that, I think if you're a retail investor and if you're looking to invest from anywhere between 5 to 10 year kind of a horizon, I would advise a very simple strategy. Please keep investing all the time. So a very disciplined and systematic way of investing is what you're looking for. For people who are trying to time the markets, I think, again, it's a good time to start investing. There are enough opportunities in the market available at great prices. So I think actually the next 3 to 5 months can turn out to be very good for equity markets.
Well, I want to ask you this. Since you said we have to invest all the time, invest in what? What should we be looking at right now? What should our focus be on?
See, if you're a retail investor, I think you do not have so much time to do a lot of analysis on individual stocks, track your portfolios, and hence the best strategy, frankly, is to stick to good, proven fund managers over a period of time. And there are tons of them in the market, and they are the way to access them is actually very easy through mutual funds. And if you look at some of the best performing mutual funds like IDFC Premium Equity, Franklin, ICICI Pru, some of these funds and some more, I'm sure your financial advisor can help you with that. Just be systematic and disciplined about investing in these funds. I think you will do reasonably well over a 5-10 year period. And let me assure you, I think there has been no period in the history of capital markets where anybody who has invested for more than 10 years has lost money till date.
Let's also talk about this. Now, when we talk about investing now for the long term, are you saying that you expect the next 4 or 5 years to be big for our large caps, for our strongly managed large caps with their track records, for the mid caps, for the small caps? What should we be focusing on as retail investors at this point?
See, one thing we have to understand, large caps are large caps for a reason, right? I mean, they have a track record, they have done very well, their management is very strong, they attract the right kind of investor, and it's a very positive, virtuous cycle which feeds them. But having said that, I think when you're looking to invest, you should not really be swayed too much by themes.
Okay.
I would always suggest look for the companies that are in the right space, right opportunity space, run by good management, and should have the balance sheets in place. I think the biggest mistake that most people make in investment is they get hurt by the balance sheets.
So when you say balance sheet, you mean not too much debt on their balance sheet,
Absolutely.
not as leverage?
Absolutely, absolutely. I think your balance sheet coverage ratios, your debt to equity, these are very important numbers. If you only get that right, I think more often than not you will not make big mistakes. And if you do not make big mistakes in the market, trust me, you will make reasonable amount of money.
So I have two questions about large caps. One is that we know that they're fairly richly valued at this point. So a company like an ITC might be a little expensive. Do you still think it makes sense to buy? And my next question to you is, gone are the days when people would buy one of these stocks and hold it for generations. Now we have investors who write to us saying that if I feel that if I didn't sell it when the market was rallying on Monday, I have lost an opportunity. So A, is it all right to buy a richly valued large cap? And B, should we be selling it and looking for opportunities to get out, or should we hold it for decades?
I am of a little traditional view in that sense that hold stocks for 10 years, 15 years, 20 years, even for the next generation, because that's what equity is meant to be. It's like building your own company. It's like holding stock of your own company. Having said that, there are some tactical opportunities that come. For example, right now we do believe that FMCG stocks are slightly richly valued, and if you're a long-term investor, don't mistake me, I mean they will do well. But if you are looking for a tactical asset allocation shift, then it might not be a bad idea to move out of ITC and to move into stocks like Infosys, to move into L&Ts, to move into a Crompton Greaves, to move into a Mindtree, to move into a Repco Home Finance. So there are a host of opportunities available right now. If you have limited amount of capital and you have made reasonable amount of money on some of these stocks, might not be a very bad idea to move out of these richly valued FMCG companies into some of, or defensives, into some of the stocks that I just talked about.
Do you believe that the sectors that have been beaten down heavily over the last 2 years, real estate, infrastructure, power, that these sectors will see some sort of turnaround going forward?
Yes and no. I mean, the sectors most likely will see a turnaround. But does it mean the companies that are in the listed
every
space,
stock in that sector is not going to see a
yeah,
turnaround?
Exactly. So I'm not sure whether all these companies will come back. And as I was talking earlier, if your balance sheet is seriously leveraged, if your coverage ratios are not adequate, I don't know how many of these companies will be able to make a turnaround. But some of the companies which have very strong parentage, they are very likely to make a turnaround. For example, Tata Steel. For example, even Reliance Industries. I think some of these companies can do very well. But there are a host of others who I'm not very sure will benefit from a turnaround in the economy.
All right, I want to talk to you about the three triggers that we talked about. We did mention the general elections. Let's talk about the possibility of a rate hike from the RBI. What are you expecting from the next policy meet, and what sort of an impact will that have on our bank stocks?
No, actually, that's a tricky one, because what has happened in the last couple of weeks, 2-3 big events, obviously the elections have very clearly indicated that price rise is a big issue. people just don't like price rise. And hence you have to keep inflation in check. This is something that I'm very sure that the government would have taken note of. Second, I think the CPI number that came out was quite a rude shock to the market. 11.4% was not something that anybody was expecting. And even Mr. Rajan, I think, came out with a very clear dislike for the number. So I'm not sure how it's going to pan out, but it's very clear that I think the hawkish regime is here to stay. How hawkish, I don't know. But for example, if it's a 50 basis point hike this time with the tone that going forward we can see more of the same, I think market will be very negatively surprised. And in the next 2 to 3 months, in this eventuality, markets might underperform. Markets might actually struggle. But having said that, I think, as I've been saying again and again, if you have a 3 to 5 year horizon, I think these are the bumps that you have to go through. But eventually, once the economy picks up, I think the valuations are great. The valuations are just great.
What sort of value are you seeing in our banking sector right now?
Actually, it's quite dispersed, if you see. I mean, private sector banks, of course, are doing much better than the public sector banks. And a lot of people tell me, you know, Nitin, the stocks have moved up 30%, 40% up from their lows. Absolutely, yes. But having said that, where is ICICI Bank trading today? Maybe 1050, which is around 1.3, 1.4 times book, with a 14-15% return on equity, with clear visibility in terms of growth. Axis Bank is trading at maybe 1.3, 1.4, with a ROE of 20-21%. NPS is an issue. But trust me, every time the markets are down, NPS become an issue. Every time the markets come back, people forget that. If you're an investor, if you can see through these ups and downs, and if you have that much patience, I think private sector banks present tremendous opportunities.
The two that you mentioned, or is there more on that list?
I think ICICI and Axis would be our top picks, followed by probably IndusInd, Kotak, and then maybe a Yes Bank.
Now, when we come back, he's brought in 2 stocks that you can buy at these levels that will get you returns in the long term. Welcome back. You're watching All About Stocks in ET Now. Thank you for staying with us. Our guest Nitin Jain is still with us, helping us figure out a long-term strategy for our portfolios in the stock market. Now, Nitin has been kind enough to bring us 2 recommendations that he believes we can buy at these values that will make money for us in the long term. A quick reminder, when we say long term, we mean a minimum of 4 years and not before that. Among his 2 recommendations are Repco Home Finance and, of course, Infosys. Let's start with talking about Infosys, because it's a stock that I know a lot of our viewers are interested in. Why do you believe Infosys has value at these levels, and why should we buy it?
If you just think about what has happened over the last 2-3 years in terms of IT, demand has picked up. I think dollar has gone tremendously in the favor of IT industry. And one of the stocks that has actually lagged behind has been Infosys because of a host of management issues. But if you see how things are changing on the ground, and when we even talk to people in the industry, I think last 3 to 6 months have actually been rather much better for the company.
So as an analyst, you believe those management issues are now behind that company, that it's going to move forward?
Are they completely behind us? I don't think so. But there is a very high possibility that things will turn for the better. Things are definitely on the up move. And I think it's kudos to Mr. Narayan Murthy. It's really kudos. A lot of people have commented a lot in terms of, what are the issues around that. But I think, frankly, he's the largest shareholder in the company, and the fact that he came back and he turned the company around in such a small span, I think is credible. And I have tremendous faith in his ability.
So if we get in at this point, where the stock is at this point, where do you expect it to move going forward?
What we expect is the company will easily grow around 8 to 10% over the next 4 or 5 years. In dollar terms. Okay. And if you add to that our expectation that your currency should depreciate by 4 to 5% every year, so then you're talking about a 14-15% kind of a earnings growth. And given the fact that the valuations are currently a little depressed, see, Infosys has historically traded at a premium to the entire sector. For the first time, it's actually trading at a discount to the sector, and I think that will also change. So a 15% compounding because of earnings, and another maybe 3-4% kind of a growth simply because of the earnings re-rating or the PE re-rating. So the stock can easily compound at 15 to 20% over the next 4 or 5 years, which is a great return for equity stock.
All right, 15-20%, that's your expectation. Let's talk about your other recommendation, which is Repco Home Finance. Of all of the options available within Home Finance, why this one?
Oh, I just love this stock. I met the management, I think, 4-5 months back, and I was very impressed by the unique business model that they have been able to create. I think the stock IPO'd around 5-6 months back, and we were probably the only ones in the street saying that it's a good stock, and it actually got undersubscribed in the HNI and the retail category, and it was only the QIBs which participated. But today, if you see, the stock has already doubled in the last 6 months.
What's special about it?
See, the business model is very unique, as I said. I think they give home loans of the size of around 8 to 9 lakhs, which is the lowest in the industry. What that means is that their portfolio is very, very distributed, and they have tremendous pricing power because there are very few people operating in that space. So their names are in the range of 4%, their return on equity is 23-24%. A small ticket home loan industry, I don't see slowing down over the next 20 years.
Isn't the risk higher with small ticket home loans?
Actually, no.
Okay.
Actually, no. If you see the track record, they have hardly lost money in the last 7-8 years. They have hardly lost money. Their NPAs are in the range of 1-1.5%. But that is largely cyclical. That is not that people are not going to pay money. It's just that they are not able to pay money right now because they're self-employed, and whenever it improves, they come back and pay. People do not default on their homes generally, especially this category of people who are earning a living out of, small jobs. So I think it's a very, very strong stock if you're looking from a 8 to 10 year kind of horizon. It can easily be trading at, maybe 1,000, maybe 1,500, 5-6 years down the line.
All right, so 2 recommendations. Remember, we did say long term, and Nitin has taken that a little further. He says 8 to 10 years. That's the holding period for these stocks. There's Infosys and Repco Home Finance on your screen right now. If you have any questions about those 2 recommendations for Nitin, send them to us on our email ID, and we'll ask him to come back into the studio and answer your questions for you. We have a couple of questions that have come in. Shrikant has written in. He has 400 shares of UCO Bank, which he bought at 79 rupees. He wants to know if he should hold on to that stock. UCO Bank ended the week at 75. Well, bank stocks have been in correction mode largely, given those high inflation numbers as well. What's your call on UCO Bank?
See, if you have a choice, I would like to get out of UCO Bank. And if I want to stick to public sector banks, then maybe I would move to a state bank, or maybe I would move to a Bank of Baroda. But even better would be if you can bite the bullet and get out of this space and move into something like an Axis Bank or an ICICI Bank. And as I was saying, I think over the next 4 or 5 years, these stocks can easily compound at 14, 15, maybe even 20%. So I would move out.
All right, another banking question. Harshal has written in 340 shares of Yes Bank, which he bought at 248 rupees. Should he hold on to that stock? He is making a profit. Yes Bank ended the week at 365. You did mention, PSU and private banks. What is your call on Yes Bank? And I also want to ask you about HDFC, because you haven't talked about it on the show so far. Where does that stand in your pecking order?
So specific to this question, I think Yes Bank is a good stock. No reason to get out. I think it's at reasonable valuations right now. Having said that, as I said in my order of priority, there is ICICI, Axis, IndusInd, even HDFC, Kotak, and then I would probably bring a Yes Bank. So my advice, maybe you can hold on.
Okay, hold on.
As far as HDFC is concerned, obviously a great story. It's just a great story, growing at 20-30% year on year, great management, a blessed stock as we call in the market. Can't go too wrong with that.
When we come back, we'll talk about stocks like Dalal, Godrej Industries and Sun Pharma. Don't go anywhere. Welcome back. You're watching All About Stocks on ET Now. Thank you for staying with us. Nitin Jain is still with us in the studio, helping us make money in the long term. We have another question. Salil Bhatia has written in. He has 100 shares of Dalal, which he bought at 155. He also has 75 shares of Godrej Industries, bought at 226 rupees. He wants to know if he should hold on to both of these stocks. A little while ago, you talked about the fact that it might make sense to get out of FMCG. What is your call on both of these stocks?
Both these companies are high-quality companies. From a short-term point of view, might underperform, but I think if you're looking at an 8 to 10 year horizon, great stocks to hold. Great stocks to hold.
Is it a good time to add these stocks to our portfolio?
As I said earlier, I think there are tremendous opportunities available. Banks, financial services, some of the capital goods companies like L&T and all. So I would not add these stocks, but I would definitely hold on these stocks if I have a long-term horizon. All
right, hold on to these stocks if you have a long-term horizon. We have time to take one more portfolio from one of our viewers. Vishal Singh has written in and he sent us a fairly long list. So I'm going to take this as a rapid fire so we can save some time. These are his portfolio stocks. 57 shares of Oil India, which he bought at 587 rupees. Hold on to that stock.
Probably yes. Probably yes. I think things seem to be turning for the good for the company. It can be a hold.
All right, hold on to Oil India. He also has 69 shares of Lupin, which he bought at 416 rupees. Now, that stock has done remarkably well since he bought it. Can he hope for more?
Definitely. I mean, great stock, great story. I would even add at these levels. I would even add at these levels.
All right, so add Lupin as well. 47 shares of Sun Pharma, which he bought at 1,030 rupees. Now, Sun Pharma has had its ups and downs. Would you recommend he holds on to it?
Absolutely. I would recommend add to even Sun Pharma. See, these companies have delivered stellar results and stellar performance over 8-10 years. Whenever they're going through a bad time, that's actually a great time to add on to the positions. So absolutely an add on Sun Pharma.
125 shares of Apollo Hospitals, which he bought at 718 rupees. Now, we know that Apollo Hospitals is a massive expansion mode right now across the country. They're doing a lot of work. They also have the pharmacy business that's doing fairly well. Hold on to that stock?
Generally, I don't like stocks which require a lot of capital to grow. And this is one such stock where you need continuous plug-in of capital. And hence, I would like to avoid if possible. Otherwise, you can even hold on to the stock. It's doing all right, but it's not going to be in my favorites list.
All right, not in the favorite list. That's Apollo Hospitals. And Tata Global Beverages, which he bought at 104 rupees. That's ended the week at 145. Lots of positive things being said about Tata Global Beverages. Do you agree as well?
Absolutely. I completely agree. In fact, I think this Starbucks story can be a big one for Tata Beverages. And they have been very good in trading. This is a commodity business, but they've done phenomenally well consistently. Great stock to hold, great stock to add.
You like the coffee? Yeah. All right, Snithan Jain likes the coffee, and that deal with Starbucks is a good idea to hold on to that stock. Now, we've come to the end of this show. Send in any questions you have for Nitin, and we'll convince him to come back into the studio and talk to us in a couple of weeks' time. Thank you so much, Nitin, for spending time with us. We look forward to seeing more of you in the new year.
Thank you so much.
All right, that's a wrap on the show. Thanks so much for watching. You'll find a copy of the show on our Facebook page. You can reach me on Twitter. Goodbye.